hawkishness when can they avoid this hawkishness when we have such solid data? Even today here in the U.S., we got those retail sales numbers and producer prices on top of the CPI data.
Thanks, Shery. Well, we believe the data will continue to show cooling, and also that the Fed really misinterprets the data because of the lagged shelter component of inflation. So if you look on the website of the BLS, they purposely lag shelter by at least 6 months, but more like a year. So our index, CPI-R, is only up 0.9% year over year. So if they properly interpreted the data, inflation would be tame. They would realize it's tame. And now even their preferred measure, which we don't agree with, but they obviously focus on, the labor market is cooling. So we think they have a case, but even more importantly, the ECB pause, and it's going to be a pause. They had a lot of discussion about not raising, is critical because we think Europe is now heading into a deep recession, particularly Germany. Definitely too near ECO terminal to Eurozone. If you read that, it'll melt your face. I mean, horrible, horrible data coming out of Germany and Italy.
The consensus seems to be that the Fed will not move next week. So are you expecting the Fed policymakers to realize this lag by November and December? Will they keep that pause?
Yes, and we're playing the next meeting is bullish because you get the SEP, aka the dot plot, and we think way more participants will have an implied pause in November. So that ratio will be more bullish. And then we think the remaining governors will respond like they already have, like Waller responded very, very positively to that cooling employment data. So we think that process will play out and we won't have an increase. Plus, if we're correct about Europe and they're in a deep recession, the Fed's not going to ignore that.
And we are even seeing more signs of a potential recession here in the U.S., right? I mean, the bond yield curve inversion, and particularly the 10-year yields below 3 months, now today marking 212 trading days. That's a record. And the last few times we saw that, we actually were able to see 8 recessions following this inversion. Can the U.S. avoid a recession? And what does that mean for the markets as well? Because consumers would take a hit.
Well, that's really the critical question that we've been answering over the last year. As you pointed out, it's perfectly reasonable to expect that there will be a recession after an inversion. There's only been 2 times it hasn't happened. But you got to think about the process that leads to the recession. Specifically, the increase in rates tanks not consumption, but investment. The average decline in investment during a recession in the United States since World War II is negative 14% on investment, mostly housing, but also autos. But we had the pandemic, we have a shortage of housing, shortage of autos, and the government is stimulating investment. So it's one of the first times ever that the government did appropriate counter-cyclical spending, not because they're geniuses, they got lucky, but that's what Senator Manchin and Sinema allowed to be passed because they're pro-investment. So it's a very lucky situation where you've got the shortage of housing, shortage of autos, and government spending, but normally we'd have a deep recession for that reason.
Jay, as I understand it, you're going to raise how constructive you are on U.S. stocks going into the end of the year. Why?
Well, we originally were way above consensus and forecast 4,500 for the S&P, which we're at right now. So we're not declaring victory yet, but the reason so our rationale was that earnings would not drop significantly, particularly next year's earnings, and they haven't because the economy's been pretty strong. And then we were using 18.5 as the multiple to get to that at 4,500. But if you look in the past, when there's these tremendous opportunities with technology, in this case AI is probably the biggest thing, definitely since the internet. So what normally happens is that companies first start to become fairly valued, like we think Nvidia has a lot of upside just to fair value, but then they become overvalued, which seems like a terrible idea, but it draws capital into those sectors. It happens in the US more than anywhere else, and that's why we beat every other nation to the punch in terms of technology, is the capital flows. It's very inefficient, but we get there first. And in technology, the first person to get the technology, like a Google, has a tremendous advantage, and that's why we have all the tech leaders, is we have this, what seems like an inefficient capital market, but actually turns out to be wildly efficient.
Tell us about some of your stock picks then in this uncertain environment, Jay.
Well, we do think that if we're correct about a strong economic environment, then on the fixed income side, you want to be in high yields, but also we focus a lot on preferred stocks, low default rates, but they do have high spreads, so they're sensitive to the stock market. So on the fixed income side would be high yield and preferreds. And then everybody kind of knows about Nvidia and tech and is usually overweight that. So we do think that the old economy, large cap dividend stocks like we have in our ICAP fund continue to be undervalued, and there is that rotation. Tech's kind of stalled, Nvidia be a good example, and like the Dow is outperforming today. We think that trend will continue. And also those stocks are lower beta, so it's good to balance out your portfolio if you're already overweight technology.